All right, so I'm done trading for the day, guys. Absolutely no reason for me to take any more positions today. My game plan today was to bank 100 points on gold and then call it the end of the week, but didn't work. So let's just run through a couple pairs. Anyone still trading, happy to look at your pair for you. So we have gold, put NAS on as well. I'm still holding my NAS longs. All right, so I don't mention this process anymore because I've shared it. And I believe if anyone is interested in using it, they're going to use it and not use it just because I point to it. This is basically the process. I don't trade before this green box gets formed. I don't trade London. I don't trade Asia. I keep my trading fixed to this portion of time every single day. This green box, this gray box. If I have a reason to believe the PM session is going to be fancy, hey, morning, it's been a while. If I have any reason to believe the PM session is going to be aggressive, then I'll trade the PM session. But primarily, New York gives me everything I need. So one more time for persons who will probably join in for the first time. This is the London session, London open kill zone. This is 50% of London open kill zone. This green box gets formed or created at 8 a.m. At this point in time, I'm just admitting some folks. At this point in time, I have all this information available for me. So why was I interested in going long gold instead of trying to go short? Because when I open a chart, I have shifted my mindset from trying to trade, but instead I'm hunting liquidity in New York. That's all I'm doing. I'm not trying to find a POI to buy or sell. I'm looking at New York for where's the liquidity that was resting in the market before 8 a.m. And that's my trade plan for the day. Recently, I shared a post, cute little picture that said, stop thinking about highs and lows and start thinking about failure swings, right? I'm going to share why I'm saying that. The high and the low of any trading range or dealing range, whatever you want to call it, is likely going to be a stop hunt. And then hearing me say that out loud, everyone's like, wow, that's actually true. But it's been true. The highest high and the lowest low is usually a stop hunt. So if it's a stop hunt, conceptually, it looks like this. Let's say we have a range. Here, let's say that's a range, right? That's a trading range. The highest high is usually something like this. Then we have all that structure inside. Terrible join, then that low, right? That's usually what it looks like. So the highest high and the lowest low is, if I'm supposed to assign a number to it, I'd say about 80% and 90% always a stop hunt. So if that's a stop hunt, there is no stops there. Because as the market's structures are being formed, we have highs, lows, failure swing. If this was a stop hunt or not, based on where we are, both this high and this low, well, this high again, sorry, will have stops because persons are now trading short these places. If this runs up and takes all the stops from here, this just took the stops, literally, this just took the stops. So why are we expecting stops to be resting here again? if that just took them. So no stops here. Market starts moving lower. We go back to looking for failure swings. Every time the market fails to take out the stop point high, you know, everyone in retail is now saying we have a high, low, lower high, lower low. This market structure is bearish. Yay. Put the stops at the high. Get in on the retracement because this is the impulse. I mean, we all know that. We all started like that. So no need to justify or disprove it. But the failure swings will hold liquidity. That's all I need to say to explain what I'm going to say next. So now, when we take a look at today's trading, specifically today's trading before 9 o'clock, before 8 o'clock. Essentially, this is what the chart looks like. With that reasoning, again, we immediately discredit the highest high. Best case scenario is it will run through the highest high. Not best case scenario is it's going to take the highs before that. So all I have to do is focus on these, the failure swings, right? Now, if that's the failure swing, this is a relatively equal high. This high barely swept above that. So this would be considered a stop point. Let me just show you what I mean. That's how I think. Am I right? Am I wrong? Doesn't matter, it's consistent. Next one, huge displacement down. This low has to be important. Sorry, that's a high. That low has to be important. We have a huge displacement through there. There's no wicks trading below here. Order pairing. That's order pairing. Then the most sensitive portion of this price action for me is going to be the candle that closes through the low. Closing price of that one in here should be sensitive. So we're now looking at price action after here. This is the start of the impulse. This is the start of the trading range. Because impulses usually start trading ranges. If you're looking at a market maker model, they all start with a consolidation and then an impulse that breaks out. Midnight, whatever that structure is. Displacement. Elephant has entered the pool. ICT term, right? Elephant enter the pool, we see the displacement, trades back, failure swing. Persons are going short. Trades up, failure swing, persons are going short. Now everyone is seeing all these highs not getting broken, which means sell when it comes back to an order block. So every one of these, just take a look at from here down to here. All these highs, none of them were rated, which means this is asking to get taken. Okay, now for my analysis process, I start looking at London session first. Asian comes second. For me, it's London is more important than Asian session because London is the second largest stock exchange, or the largest, one of them. Highest high in London. This is best case scenario again. Failure swing. That's my target. Failure swing. That's my target. Failure swing. That's my target. So these price levels are my target at this point in time. At 8 o'clock, when I see this structure, this is my game plan. I'm gonna raid these stops, or I want to be a part of the market makers when they go run these stops. All I need is a market structure shift. Now, there are different ways to define a market structure shift. You could use a break of this high, right? Didn't get broken here, so you wouldn't have gotten your market structure shift here. I don't define market structure shift like that, but that's a different story. So all we want in here is a market structure shift, and we're good. I bought gold at 1785.5 right here, in there, basically. I bought here, 8 o'clock opened, traded low. Now, for me, if the market's bullish and we're in the lower portion of the range, there's only two things we could be doing down there if the market is bullish. One, sweeping sell side liquidity. Two, looking for bullish arrays. London is all the way up here. So I can't look back to find a London order block and assume that we're trading down into London, which is what I love to do. I love doing that. I love looking back at New York to find a London order block and then key off that. So we could go back many days. Here's another day where we're below London in New York, so you can't use that. New York, London order block. We're way too high in premium here, so this wouldn't have given you an ideal entry, but that's fine. We'll talk about that in a second, Nicole. I was trying to find at least one example. Well, I guess you could check that. I don't see any right here. But again, just check and you'll find them. Here's a London order block. So nice example. We're bullish because all of these highs are left intact, right? If the market opens at 8 and starts trading low, it's doing one of two things. It's raiding stops or bullish array. So we already know where we're going to be looking. We're going to be looking at London lows and lows inside here that were not rated. This gets rated perfectly fine. We're not trying to move the market whenever it comes to the order block. We want confirmation that it's going to move. So let's say hypothetically we're trying to get in at the opening price of that candle. This is not an entry because we don't trade outside of this green box. The market's trading down here. Do you see an entry pattern here? I don't. Do you see a bullish market structure shift here? I don't. So are you going to just buy this just because it's an order block? Then that's madness. Relatively equal lows gets created. Price runs through them. That's a stop point. Now my model starts popping up in my mind. And again, that model is on YouTube, so no need to explain it again. The model is popping up in my mind. But now my model is going to be keying off of London order block. Here's a stop point. There we go. Market structure has shifted. That's a buy. Now, if you enter at this down candle, where are you going to target? Same thing we just talked about. From this high, we're looking at the failure swings. There. That's the first target. That's the failure swing. Second failure swing. These are the failure swings. This one got tagged. Not convincingly, but it did get tagged. So we're entering at this down candle. We're aiming for these. Best case scenario, again, is this. So there, that's 50 points. That's 65 points. Call it 60 points. That's your trade idea. No overthinking, nothing telling you to look for multiple things. I don't need to switch time frames here. I have framed everything I need from this time frame without checking for higher time frame bias or anything. I'm simply trading liquidity. So the market can trade from here up to this high and then scream lower. I don't care. My job is not to move the market. I'm just hunting liquidity. And I can see where the liquidity is resting here. Entry, exit, game over. Let's get back to what we're talking about today. So same thing I just talked about, same thing what I saw here. Trading down, we're way too deep below London low at this point in time for me to try factoring London low order block for an entry. Absolute madness. If you see something like that and it works out, it's an anomaly. It's a one-off scenario. It's not something logical. But I see this low. I see a run below that low. So I'm going to buy that. When am I going to buy this? We have to close back above here. This was a stop point. This traded above here. That candle right there. Let's actually put the line on. I'm going to buy the retracements once price comes back below this red line. on any time frame. I could use a 1 minute time frame if I want. There it is. I do. Market structure shifts simply means there's a point in the market where price should not come back above. If I have sufficient wicks or sufficient range from a wick going above it, then I'll trade it. I don't need a close. So let's say we have this right here, and I'm looking for a market structure shift to be price going back above here, that red line, after the stop point. So no subjectivity, no trying to form fit it. We're watching the low right there. We're waiting for a market structure shift above before we start stocking entries. Stop on happen, market structure shift, I start buying. If we take this to an M1 chart, my entry again was, let's leave that intact. That's the low. This is the 5-minute order block. I entered at, I don't want to lose this line, so let me just pull this over. I think it's about there. I entered at 1785.5. Could be easy to just type in the numbers, but hey, I entered there. Now take a look at this structure. Take a look at the stop point. See when the stop point happened. This is the stop point. We want a shift above here to get involved. There's a shift. Price comes down. We buy that. That's what I bought. Why did I buy this instead of everything else? It's a little trick that I use, and I'm going to show you today. I'm going to share one of the tricks I use when I'm looking at failure swings. So let's zoom up on this bit of price action for a second. This is the lowest low in that swing. Failure swings after here are going to be this and this. So I can buy the stops resting below here. There we go. Just buy that. Game over. While there are other things inside here that we could use to frame market structure shift, we don't need too many moving parts. This is clear enough. Failure swings, stop hunts, buying the liquidity below. Game over. So I bought that. And my target was way higher. So while this was happening, I wasn't really interested in taking here when I can see that the draw on liquidity. I'll post the recorded video on YouTube here. All my recorded sessions are on YouTube. So when I saw this, I had no reason to believe that there's any reason to go out lower because the stop one that already ended. So this took me out at break even. And then the market screamed higher, literally. Right after it took me out, it never came back. But that's the logic behind why I was bullish and why I wanted to see that. Now, I'm going to take you to NAS, the NAS chart that we did this week. Right. NAS possibly took me out at break even too, if it's trading below 3.9. So just put the random dividers on and measure 5 days. This is this week, that portion right there. Bam. That's this week. Now I'm going to share something here regarding what we just talked about in terms of failure swings. The trading range, I mean, I'm a math student, so I usually start all problems with an assumption. It makes life easier because you have something to work towards. So if you start with an assumption here, assume that the lowest low is a stop point, right? We could see this as the lowest low. But remember, the assumption is the lowest low is a stop point. The assumption is used in place where the price action is not clear enough for you to definitively say this is a stop hunt. So if you can clearly see a stop hunt, then you can clearly identify the low of the trading range. So add a few persons. When we take a look at this price swing here, this is the last stop hunt in the market. So I don't see any reason for price to go below here. So we're going to go back to looking at exactly what we just talked about, the failure swings. This is where the week started. Let me just slap a line there. So no cheating, guys, no cheating. Week opened right here, and we did our analysis. When we looked back at all of this price action, this is the lowest low. So take a look at all these higher lows after this low was formed. Every one of them, it's a failure swing because it didn't take out the stop hunt. Now, where's the lowest one of them all? This one. I don't have that thing on. Just a second. Let me load that. There we go. So I'll have to do this again real quickly. There is our thingamajiggy. There's our start of the week. That's all we need. This is the last stop hunt. Now you could frame any other strategies that you use around here to justify this is as a market maker model. Fine by me, doesn't matter. The narrative on the logic for me is this is the last stop hunt. The failure swings are now all the higher lows after this point. So at the start of the week, I was saying that we need to go lower to accumulate. We outlined where that void was on the daily chart. Just hop over to the daily chart real quick, put some context behind it. There's that daily void. We mentioned if price closes below here, that is going to scream low. That is going to die, quite simply. Now, if it's going to die right there, I'm going to incorporate a couple aspects of the daily, of the daily chart and then show you the narrative. On the daily chart, this is the last day where we ran below a previous day. So the failure swings are the daily lows after this one, which makes that your daily liquidity pool. Or based on my understanding, let me put that disclaimer out. This is what I believe the daily liquidity pool is. This is not financial advice. There's risk in trading. If you put money on, it's your fault if you win and your fault if you lose. There we go. So this is the last daily stop hunt. This is now the next failure swing on the daily. Take that level and transpose it to the hourly chart. This is the last stop hunt. Which other hourly wick is higher than this one? This one. So this is my target. This is my best case target. So here we're framed two logical liquidity pools that the price could trade to. Low hanging objectives, best case scenario. When price was trading below here, I said I was going to close my shorts in the group and anticipate London close profit taking. London close starts at 10 a.m. On this broker, it's 1700. That's London close. London close profit taking, we have time and price overlapping. What does that mean? Logical liquidity pool where the market can stop or sellers can take profit. What time of the day do traders take profit? London close. Time and price meeting right there. I'm expecting a reaction. It's not always perfect because there's narrative, but we have the end of the quarter coming up right there. So that is everything I need to frame getting out right here. I don't care if it screams low. If I got this to this, And that's a good trade. There's absolutely nothing to worry about there. So I exited here and I went long in here. And the entry model I used inside here, I've not shared that publicly. So we can look at the trade setup, but there are other reasons why you could have gotten in here. But again, I didn't share that publicly. Now let's take a look at this bit of price action here and look at when was the market actually bearish. If the market traded inside a range, and again, the range is going to be the highest high, lowest low, here to here. Once we start closing below lows formed before the highest high, that constitutes a market structure shift. It cannot be a market structure break if we're trading inside the range. Makes no sense. Market structure shifts happen inside a range. Market structure breaks happen outside of a range. So if we saw this, and based on ICT's definition of a dealing range, this is a dealing range right there. This is a dealing range. This dealing range on an hourly chart was broken right here. This is not a shift. This is a break in the dealing range. See that? Context. The dealing range has been broken to the upside. What am I going to do? I'm going to go back inside this range of price. This range of price is not necessarily this price swing. This price swing is only marking price in this time. So a price swing marks price in time. A range of price is not confined to time unless it's specifically a timed range, like a London range or a New York range. This range of price is that high and that low and everything between it. So I can do this. I can pull this box all the way over here if I want, but that's too much data, unnecessary. These are the lows. This is the stop point. So if this is the break in the market structure, we're expecting a retracement inside the range. This is the range. What are we looking for inside the range? Bullish arrays, to put it simply. If you trade my model, you know exactly what I'm looking for. This candle's opening price. That's what I'm looking for. This candle's opening price. Break here gives me my bias for going long. This price gives me my entry for going long. That's what we have right here. Yep, I'll put it on YouTube. I'm only mentioning YouTube stuff, so no secret sauce or anything like that. Why that candle? Because that's my model. The model I shared on YouTube, very rudimentary. If I draw it, looks like this. Range. Price taking both sides of the range and coming back and going. There we go. Gold failure swings in London. Not sure what's happening on gold chart. Look at that. The liquidity levels we outlined, taken. I think it fell short of this one by a little bit, which is why we aim for bodies and not always wicks. Wicks are best case scenario. Trade back down, nice fair value gap, order pair in theory. Someone's in the chat. That's it. That's the order pair in theory right here. So I can't see this candle's high, so I'm just going to assume that this one is higher. That's the portion of price that needs to be rebalanced. There we go. So whenever that happens, resistance broken becomes support, has a higher probability of playing out. Is it going to hit here and then scream higher? I don't know. But I can get a high probability swing scalp from that price point. All I have to do is refine my entry inside the FEG. Tag it, game over. From here to here, looks like about 30 points in a few minutes. liquidity. It would be nice if it touched the order block here. That would be more logical for me. What's the name of my platform? MT4. Not sure what indicator. This indicator, I can send the indicator in the group in Telegram if you guys want it. But this is a template that I created. The NAS break. I'm not sure if you haven't seen my the trading model I put on YouTube, then you'd have to watch that. I don't want to take all the time explaining that when it's already there. Watch the YouTube video. So when we take a look at the lows at the high, we can see where we could assume a market structure shift could happen. Breaking below that low. Candle closes below the low. You could factor in just about anything here that you'd like. Breaker. Short-term highs inside here. Failure swings. Those get taken. Good. Mitigation. Everything you want to use is inside here for an entry after we close below this low. So on this day, there's a buy stop inside here, but irrelevant. On this day is when everyone was buying. And I was patiently waiting for the sell because the daily chart required a failure swing to go lower. It required it. And I could see the liquidity levels that we could target. There it is. Everything here that we need. Everything here that we need, which is why I bought here. So just putting that out there again, let's even look at NAS on a 5-minute chart. Same idea. Here's London. Opens here. Are we bullish or are we bearish? Well, we have failures in here that we could target. This was the lowest closing candle in London. That closes there. So this is the lowest one. This is the lowest closing price in London. So this is my London order block. So I want to get my entry at least below the opening price of that candle. You just took it. Nice, nice, nice. No, again, when we're looking at these, where are the failure swings? Failure swing, got raided. Failure swing. This, in terms of structure, this is a short-term raid right here, but all of this is still higher than this low, which is the stop hunt. So if I'm being very meticulous, and this is the last stop hunt, and I'm saying it's the last stop hunt because it took there. I'm not expecting it to take this because this took that stop. So after here, where's the failure swing? Right below that low. So this is my order block. This is my liquidity pool. This is where I want to buy. After liquidity is being swept, I don't think you can anticipate a failure swing, but more look for it. Once you see it, you use it. And that's where time comes in. I'm not going to be buying this a second before 8 o'clock. Failure swing, relatively equal lows, low resistance, buy, game over. Buys, lots of buys inside here. But the narrative is what's important. Looking at this structure, it's easy to see it if I'm explaining it. But if you understand why I'm choosing those structures, you could pick any chart you want. What's here? EU. Let's look at EU. Same idea with EU. At this point in time, stop staking, failure swing. All of that, stop staking here. So the range is now the highest high, lowest low. This is the liquidity inside the range. Liquidity taken, below the low, we closed with bodies. Order pair in theory. Price trades up, immediately moves lower. There's nothing bullish about this. But we can see failure swings if we get a market structure shift. EU is very bearish right now. Very, very bearish. So here, this is a market structure shift. This is a buy. I would buy this. I'm not going to buy this. I'm not telling anybody to buy this, but I would buy this market structure shift here. Would it be worth my while? My max risk would be about 13, 11 pips. Failure swings, failure swings, failure swings. This is the highest area I'd be open to keeping the trade unless we break above this gap right here. So if I bought that, I need strong confirmation above that level before I would entertain holding this trade for longer. A failure swing is every lower high after a stop hunt on buy side liquidity, or every higher low after a run on sell side liquidity. So you could rewind that and put that in context. Now, most persons would feel some kind of way about losing a trade like this. Why? I see people losing 500-point trade and still saying that they can trade. This is a 10-point trade or a 10-pip trade. If I took this right now and I lost it, there is absolutely nothing to worry about. I'm not blowing my account on 10 pips because I'm not going to over leverage on 10 pips. See that? From a risk perspective, I'm risking less than I could make on worst case scenario, which is right here, or low hanging objectives. So if my risk is far less than low hanging objectives, this trade is worth my while. That's why I look at risk. So same thing on EU. We could see that there's absolutely no reason to buy inside here. So if you bought EU and you lost, the narrative was not bullish. There is nothing here saying that the market was bullish because we just broke outside of the range. Order pairing, we didn't get back above here. Why am I going to buy this? Absolutely no reason. This is a short-term market structure shift. Is it convincing? No, not really. Why is it not convincing? EU is way too bearish, but this trade from a rules-based perspective, I would take, if that makes sense. But again, I'm not telling nobody to go buy that. So Nas, I'm not sure if, I think Nas stopped me out, or probably stopped out some of the positions because I had something inside here. This is still on, and this is probably still on from a 5-minute perspective. Yeah, I bought this low and I bought this low. So I think I'm still in this trade. I had something up here that would have been stopped out because it was above 11,400, I think. So that would have been stopped out. But I'm probably still in that trade. So that's how I look at it. So hopefully this was able to help you plan for next week. Thank you guys for coming out and enjoy the rest of your day.